encouraged a more asymmetric approach to monetary policy, that if strong growth comes through, they don't have to hike, but if growth weakens, they can cut. Does it temper their ability to respond to adverse shocks if inflation remains sticky? You're saying they can still cut. I want to understand by how much. Are we talking about 1 or 2 versus, say, 5 plus?
You know, it's interesting because I think it really comes down to the composition of inflation and where the stickiness comes in. If it ends up being on the supercore measure, which is highly correlated with wages, that's a problem for the Fed. If it's housing, if it's OER, if it's rent, that's a residual from what happened a year and a half ago. And if that ends up being the case, then they can easily justify moving back closer to neutral if the situation warrants it. And what warrants it? It certainly isn't a flat GDP print. It would have to be well into negative territory.
Which raises this question, what is neutral? And I keep going to Elsa Linios and this idea that she was saying maybe neutral, in their view, is actually north of 4%. And that's what we're looking at, this sort of rolling ball of cash that's shifting into different areas and causing inflation to surge in different places that will keep inflationary pressures higher than they have been traditionally. Can you get on board with that?
I'm very much on board with the notion that neutral policy rates are a moving target, and it's not a single number that will hold indefinitely over time.
Guys, احضروا هون.
I agree that because of a lot of the dislocations that occurred during the pandemic, that our star was higher over the course of the last couple of years. The bigger question becomes, what is it like at the moment? Are we truly in restrictive territory? The combination of the balance sheet rundown and the fact that as year over year core inflation numbers start to decline, real policy rates will increase, really puts the Fed in a unique situation, and one that I certainly don't envy.
Well, what do you think? I mean, do you think that it's restrictive based on the evidence that inflation isn't really getting tamped down as much as people expect? And sure, we got one weaker than expected retail sales number, but you look at the earnings and companies are still doing all right.
So I would say that it was clearly restrictive during the second half of last year, which is why we saw the progress made on the inflation front. But the equity market doesn't believe that it's restrictive, and that's actually really problematic for the Fed, since overall financial conditions are much easier than Powell would want them to be. And that feedback loop, to a large extent, is why I believe that there is some stickiness in the inflation complex at the moment.
I've got 2 questions. You've kind of alluded to the fact that you think he cares about equity markets, but he barely talks about financial conditions. When we raise the fact that equities are close to all-time highs and credit spreads are super tight, get people come on this program and say that's not that important to Chairman Powell anymore. Why do you think it is important?
I think that he's very strategic in the way that he chooses to emphasize the relevance of financial conditions. When they were tighter at the end of last year, it was very important because it was consistent with the messaging that he was putting forward, which is we're nearing the point where we're going to start cutting rates. If the Fed starts to reintroduce the conversation about financial conditions, that's hawkish in this environment. It's not dovish. And that would suggest that while the market seems content to price in a June rate cut at this moment, maybe the real departure point for normalization is July or later.
$20 trillion call for you now, Treasury market. What do I do with the long end? You've told me what you think is going to happen with the Federal Reserve to some extent, what that could mean for the front end of the curve. What do I do with a 10-year? What does that look like in the world that we're starting to sense is developing in 2024?
So I would say that we are in a period where we might see upward pressure continue to develop in the longer end of the curve, but 10-year yields aren't going back to 5%, and eventually we will find ourselves in a situation where inflation does start to moderate, and that means break-evens will compress, and that means that 10-year yields above, let's call it, 435 or 450 start to look attractive, but we're not there yet.
Which is really the reason why I was going to Elsa Linios' call. And people might say, R-star, neutral rate, my eyes glaze over, I don't care. But the idea here is that if the overnight rate is more than 4%, it doesn't make sense for 10-year treasuries to be trading at 4.27% currently. They would be trading at a much higher rate. So at what point does this market sniff that out? Since right now, there is none of that being priced in.
ما خص.
I would say that logic holds very well for the 2-year sector, and the operative issue is whether or not the Fed ever chooses to review the 2% inflation target. Because even if our star is higher, if the Fed is going to get us back to 2%, that just means they have to risk greater demand destruction to get us there. And so, like I said, I'm very, very on board with bearish in the front end of the curve. Really hard to justify 10-year yields at 5%, even if our star is 100 basis points high.
To put a bow on it, are you basically saying the biggest risk case for next week is for Fed Chair Jay Powell to come out and say, I care about equities?
I would say the biggest risk for
Small.
next week is that
Small.
We all look at the 2024 dot, and it says 50, not 75 basis points worth of rate cuts, and that's what triggers a more dramatic bear steepening.
Andrew Honorholz of Citi just published on that. He said 75 basis points. The median dot will still imply 75 basis points. Can we have your base case? Is it 50 or 75 next week?
Base case is 50. Base case is 75, but there is a real risk of 50.
Interesting. Ian, thank you, sir. Really thoughtful stuff. Ian Lingenmet of BMO. And what's developing in the economic data, Lisa, and how this Fed's going to respond to it later this year?
Given the fact that you've got both, you've got a little bit of everything, which is the reason why Andrew Hohenhorst actually has been talking about the weakness, allowing the Fed to cut more. And even at a time where there is this inflationary pressure, tough moment, really tough moment.
Oh, big time. Getting closer to 430 as well on a US 10-year. Yields have been creeping higher throughout this week on both the front end and the long end. I think on the long end we're higher by something like 20 basis points on the week from around 4.1%, getting close to 430 at about 427 right now. Coming up in the next hour, the third hour of Bloomberg Surveillance just around the corner.
Yeah.
We'll catch up with Sam Stovall of CFR.
هلا بعملكم سمري عشيه بس نفوت لايف عشيه بنحكي بس كان بدي اياكم تسمعوا للي سمعوا بيكونوا فهموا عن شو عم نحكي اللي ما فهموا حارجع اعمل تلخيص بالليل بعد الماركت باي